Hi everyone, welcome to the Sophron Network, the podcast where we bring together industry professionals to give you insights that you wouldn't get anywhere else. Today we're here with Rozario, who is the CEO and founder of Alphaparty Capital, a digital asset hedge fund based in Amsterdam. And yeah, we're really curious to see what kind of insights you're going to give us today. Arnav, maybe you can do a short introduction about yourself and also about Rob and like his work, so that we have a bit of context.
Absolutely. So hi guys, welcome back again to the Sophron Network. My name is Arnav Sathe. I'm the founder and head of quantitative operations over at Prometheus Capital. It is a student-led investment fund out of the University of Amsterdam. We started about 2 years ago, and we've been working quite closely with Vincent and AIC. So Vincent and I got close and we started doing these podcasts. Now we get to meet really cool people such as Rob Rozario. And to give a quick introduction to our guest of honor today, Rob is the CEO and CTO of Alphaparty, an Amsterdam-based asset management and trading firm running alpha-rich strategies across digital asset markets. Before Alphaparty, he led trading at a digital asset firm running DeFi, digital asset derivatives, and market-making activity. His early career spans 2 decades in exotic and structured derivatives, Lehman Brothers in Tokyo and Singapore, where he built the commodity exotics and hybrids business, and a liability franchise across Korea and Singapore. Nomura in Singapore, covering FX structured products across Asia, ex-Japan, and building an FX Flow exotics platform. At Leonteq, formerly EFG Financial Products in Zurich as head of FICC, structuring and executive director. He was earlier a risk manager in Melbourne, a quantitative analyst on interest rate exotics, and a university lecturer. He holds a bachelor with honors in Applied Mathematics and Astrophysics from Monash University, and pursued doctoral research in financial mathematics at UNSW. Now, with such an extensive CV,
that sounds very impressive. Yeah, that sounds very impressive.
Really
I like that.
You really do. So we're finally have the man, and we're gonna have a conversation with him. Let's see.
Yeah,
Great.
so
thank you. I saw you dig deep in LinkedIn to get all of that information.
Exactly.
That's very good.
Yeah, we went all the way through. Then we scraped the whole background and tried to find all the ins and outs.
That's the way you do it. That's the way it's done. That's good.
So also a short intro from my side. My name is Vincent, started Sophron, and like I mentioned, we try to bring together as many industry professionals as possible. So today, with like your whole track record, we wanted to cover different themes from like exotic and hybrid derivatives to institutional adoption of digital assets to risk management. There's so much to talk about today. Where should we get started in terms of you spent like you spent like 2 decades structuring exotic and FICC derivatives at Lehman, Nomura, and Leonteq, and then you moved into digital assets. Like, where did you decide to make this move, and how did that sort of come about from more traditional to now in digital assets?
Yeah, it's a good question. I would say that we were moving back to Europe from living in Australia. And I needed to go back into the markets to earn a ton of money again. That was really my mandate for my wife. So she always says these things. So for me, it made sense to go and do something new rather than go back and do things I'd done before. When I was running FICC structuring, I reached the top of the tree in that, right? And I'd done that. I'd done trading, I'd done structuring, and I wanted to do something different. And to me, when I saw digital assets, I thought this is a very interesting space. I talked to people in the space, and I really felt that most of these people were clowns. They didn't really understand risk management. They didn't really understand. They could talk about these amazing returns, didn't talk about risk in any way at all. I think that was embedded in me from my time in these institutions, right? So in my mind, once this becomes a professional, institutionalized asset class, which we can actually come into, then risk management is going to be really important. And people like me that have a strong TradFi background can really act as a bridge between the traditional asset classes and this new one. So that is where I felt I'd add a lot of value. And I thought that's something I can do. That was interesting. And at that time, digital assets, as I like to call them rather than crypto, was in a very different place. It was much more retail orientated. You had the NFTs that came up around then. There were meme coins and all this nonsense. And now I feel like we've moved to a much more professional footing. Right?
Yeah.
A lot of the rhetoric around tokenized real world assets is starting to become real now. We're really seeing a turn in the last year. Right?
And then also because you talked about risk management. Is that something that you learned, for example, at a Lehman Brothers? At Lehman in Tokyo, you built commodity exotics and worked in the hybrids business. Working with such different products, does that help in, for example, digital assets or the way that you approach risk?
Yes, it does. It does. It really helps. I mean, there are many different aspects to risk you have to consider, right? I mean, there is market risk, which is maybe the most visible one. But then there are ones that you don't see, like counterparty credit exposure is a big one, which is the price and understood and not completely well understood in this industry at the moment. So, for example, you trade on FTX and you leave your capital over there. What happens if FTX goes bankrupt?
Yeah, and that's way more important than digital assets, right?
Well, it's important. It's a risk that you have to consider, right? Yeah. So how do you manage that? And there are different ways you can think about that. You can have a custodian, which carries your assets, but counterparty credit exposure is one of those risks that you can never mitigate, that you can never eliminate. You just move it from one party to another, but you want that other party to be more trusted, right? So there are these kinds of things need to be thought about. And in this space in particular, there are a lot of specific risks mainly here. How do you transfer things? How do you, all of this kind of stuff, which is very unique to the space.
Yeah, because I can imagine that sometimes you don't need to think about it from that perspective when you're in this sort of regulated environment, right? If the space is more maturing now.
So in terms of it's definitely maturing a lot more now. You're getting better principles, better people who are thinking about risk, and they're putting up proper policies in place and proper frameworks in place. The regulatory environment has changed a lot as well, but there's still a long way to go. You have to think it's still a tiny asset class, right? We're looking sub 3 trillion. We look at global equities, it must be 200 trillion, something like that. So it's just a drop in the ocean at the moment. So you can understand that if you go to institutional players, they just don't understand what digital assets are or stuff. They don't even know what it is. They haven't even looked at it. Nobody's even explained it to them. So there's this education piece that needs to go first. But everything is maturing. It's good. I'd like to see in the last 2 years, and especially very quickly since mid last year, we've seen a lot of more sophistication in the market.
But now going kind of piggybacking off of what you've already said, you come from, or in your background, you've reached the pinnacle of structuring in I guess on
I'd reached a very high level.
I mean, let's say
let's say I was the king.
You are pretty much on the throne, right? Well, so but then when you went more into the digital assets and now you're looking at it and it's sort of becoming more sophisticated and it's becoming a bit more institutionalized, what would you personally say would bring in liquidity if you were to look at it from a structuring perspective and from an institution's viewpoint? How do you think you would be able to bring liquidity into the market?
Look, at the moment it's time. You need time. You can't shortcut time. People need to be educated. What is crypto? How is it? And the thing about people in finance is that they're quite arrogant. They don't want to admit that they don't know things. They know everything, right? So actually, when I was at Lehman Brothers, I needed to educate salespeople on FX structured products. And so what I did was I mandated that some of the salespeople they had to sell FX structured products. Otherwise, they weren't going to get their full bonus. So now they were incentivized. And then I set up FX University and I forced them to go to it. And FX University had the dumbest, most basic FX concepts, right? Which they would never admit they didn't understand. And they had to sit through and go, oh my God, I know all this. Everyone knows this. But they're actually learning and they wouldn't want to admit it. Of course, I know all this stuff. I've seen this before. Everyone knows this, right? Okay, because they're too smart, right? And then they start selling products, right? Now we have to do the same thing in this industry. We have to have people touching digital assets. They need to see them. They need to understand more about them. And the more education you have, the more you can, before you can consider investment, first you need education. You can consider it, then you can actually make it.
Yeah.
Right. But it's a process, and everybody needs to understand what's going on.
Why
because you imagine you go to an
institutional,
like an institutional allocator, right? They have an investment committee. They have a risk committee. All these guys need to tick off on this, and they need to understand what they're doing. Otherwise, they won't tick off. Right. So it takes time.
And why has it taken so long for crypto now to even there's been a lot of pushing on certain verticals, but now you see that everything is kind of going rapidly with RWAs and everything being tokenized, and also the stable coins and all of those verticals. But why has it taken so much time until now for it to finally sort of click?
I wouldn't say it's taken that long. I would argue that it hasn't taken that long at all. I mean, we're not talking that long. We're talking 7-10 years. That's not a long time. And having said that, you need really, why do you want to do crypto? What's the point, right? I mean, what is the incentive of somebody to look at this? It has to be a genuine use case. Now, with stablecoin payments, there are genuine use cases over there. I've talked about this before. I had a physical trader, physical commodities trader in Dubai, and they'd started using stable coins, so USDT, to settle transactions that they had. They have all these cross-border payments. They might have a ship that's coming into port. They need to pay the port authority. If they don't pay by a certain time, then they get fined, right? So crypto payments, the stablecoin payments are instantaneous. There's full transparency payment. It can't get held up by some third-party correspondent bank, right? Yeah. So this kind of stuff is interesting. There's a genuine use case there, right? So they end up saving because they don't have to pay a fine, or there's less chance that they have to pay a fine. So that wins for them, right?
Yeah.
And they have to pay JP Morgan their exorbitant fees, but they have to, right?
So what happens to the JP Morgans then, or those kind of banks? Because you see a lot of banks are now...
Oh, they're very smart. They're very smart, very sophisticated, right? So, as JP Morgan have their own coin that they're going to be launching, they're going to be trying to solve all of these problems. They're not going away anytime soon, and neither should they. They're the backbone of the global financial system, right? They have and they own the relationships with the end clients, right? And that's where everything gets interesting. That's where they make a ton of money. So they're not going away anytime soon. They're going to come as these become sought after, as solutions become sought after by their clients, then they will start delivering them to them.
Because you were also featured in a new Citibank report, right?
Yeah. There was a tokenization report by Citibank. They interviewed me for that report. They won my
That was very recent, Yeah,
that came out 2 weeks ago. That was a landmark report, which was launched at Proof of Talk in Paris.
And you were in it. So
I was in it. Yeah, it was nice.
It was around.
They quoted me.
Yeah.
Did you read the report?
Yeah, I read some parts of it, and I read also some of the parts where, for example, you talked about the RWAs, that in 2030 you expect a very large amount of the public equities to be tokenized. What's the reason behind that?
There's a use case. I don't think it's going to be global, but in some markets, if you look at in the US, I think it's the NASDAQ, you have the top 7 stocks. They account for 50% of the market cap of the exchange, and they're big brands like Tesla, right? Who doesn't want to buy a piece of Tesla? It's a brand like Coca-Cola. So people have opinions on these things, right? Maybe somebody in some third world country that doesn't have access to a Robinhood could actually buy a small sliver of Tesla through. And also the other thing about public markets and public equity markets, they're not 24/7 markets like crypto markets. So I think crypto markets are really going to push equities markets specifically to move to more of a 24/7 trading.
Do you then need even NASDAQ to fully become 24/7, or will it be another platform next to it where people are just trading 24/7, outside market hours? And
I think most likely it's going to be the established incumbent exchanges will start to widen their trading hours.
Okay.
Yeah, and in crypto now, because you've as you've talked about, like the Citi report, for example, with tokenization of, in most of the public equities or like the markets itself. Do you think there's going to be like unique structured products coming out of digital assets, like in the coming years? Because like,
maybe.
Yeah.
I mean, one thing that was really interesting to me initially about digital assets was the opportunity to overlay structured products on them, right? Generally, the way in which structured products are settled is quite messy. You have to have dedicated staff sitting in a room calculating what event happened, and if it happened, then what the payout's going to be. This is cumbersome, right? I mean, even though most of it's automated in their own systems, it's still cumbersome. So all of this goes away if you have smart contracts, right? I mean, you can automatically calculate whether something happened or not. You can have an oracle with this, and you have a smart contract, and boom, automatically the payment goes out. So from a structured products perspective, I mean, I always say this. So innovation in banks and financial institutions is predominantly driven by cost saving. So if you can save money, so you don't have to hire those guys, and you have a smart contract, boom, you save money. That's a win, right? That's a use case. That's what's going to move people to do structured products in an on-chain kind of environment. Are there going to be unique products? I think there's an opportunity for them to be. But structured products have changed a lot since 2008.
Because I mean, I was also asking, because you've seen the liquidity in TradFi when you come up with a new like product, right? Like it's not like you're artificially creating liquidity. It's because you as a banker or as a sell side guy kind of understand that, hey, there is a market for this product that I can sell to people. But with the lack of liquidity, as you said, with time, do you think like the innovation is also like stifled because of the time factor at the moment with the liquidity in digital asset markets? Like in the sense that if you're rolling out new products, but there's like the lack of liquidity already in the markets where there is not the amount of potential customers that would buy it, do you think that's also halting the innovation in that sense?
Not really. I mean, I think that structured products are very secondary thing, right? It's not the primary motive.
Something where like eventually you kind of want to release products that are also, you don't want like artificial like people buying it just because, right? Because the markets are going up, or that there's
a lot of the reasons that people buy structured products is thematic, right? They'll read something in the newspaper about oil going up, and then you might want to craft a product around that, which encapsulates a specific view that'll go up by 20%, but not above 50%, right? You don't think it's going to go down, but it might go down. If it does, you want to be protected, right? So you can put a package like this together as a combination of different options, and then you wrap it up into a note and you sell it to people. But it's often very thematic.
And how was it for you to make this whole transition from, because where do you all work? Like, where in the world? There's like so many countries that you work.
Where did I work?
Yeah,
well,
like
I worked
so
in
many
Melbourne,
different...
Sydney, Tokyo, Singapore, Zurich, and Amsterdam, which is where I am now.
Yeah,
so I've
which is
worked all over the
crazy.
place.
Yeah, and like, do you see that there is like a different kind of cultural approach at also like the kind of countries that you worked or in these different venues? How was that for you to like have so many different insights from all over? Was there a different approach to certain products or certain companies?
Well, there's different cultural fits within different organizations. That's probably top, I would say, before you get to because a lot of these banks, you have to understand, they have a culture within them, which is almost unique to them. And they carry that around the world. So even if they might be in Tokyo, so Tokyo Lehman Brothers had a very American type of culture, right? Even though we were in Japan. And in fact, most of the people that worked over there, certainly the ones I interacted with were not Japanese. They were Americans, or they were Canadians, but they were typically, or French, a lot of French people in derivatives, but they weren't Japanese. So in some sense, it's a bit isolated. So you need kind of bubble.
And then
the culture
also
of
like
Lehman Brothers was very American.
Yeah, because like also like the crypto world is still like a bit of a bubble, right? Like the kind of people that you interact with and such. Do you also see that needs to change to?
I think it needs to change. I think it will change. I see it changing already. I mean, the people that are coming to the market now are much more sophisticated than they were when I first got into the space. But the reason I came in was because it looked so easy to make money here. The margins were massive and people didn't know what they were doing. So, well, I can eat all these people for breakfast. So why did I do that? So that's why I started.
That's also something where like we heard it a lot, right? Like that, like the crypto markets have become so competitive now.
Yeah.
With all these like large market makers and such.
Yeah, I think it's a good thing. I mean, it's a good thing. It's the kind of sophistication that you need. So you can moan and say, oh, well, these people are taking all my alpha. You can say, I need to be better. Right?
Yeah.
And I think it's a much more positive way to approach it. I mean, you can't expect to get special treatment because you're in the small little asset class. Right?
Yeah.
I mean, you need to play with the big boys. You need to work out what you need to do. And either you don't and you go home, or you do and you make money. And so it's really on your up to you. Sometimes a lot of this has to do with budget as well, right? I mean, if you're a smaller shop, you don't have the resources of a Jane Street, right? But then you have to find unique places where you can compete. Right? So, for example, there are different types of markets where smaller shops can actually do a lot of damage, right? And there isn't competition from guys like Jane Street because the opportunity is too small.
Yeah.
Like,
but for them, it's like,
unless you're gonna, they have certain budget constraints, right?
Yeah.
If they can't earn more than say 100,000 a month or something, they wouldn't even do it. It's a waste of their time. So you need to but for a small two-man shop, if you're making 100,000 a month, maybe that's a lot of money to you, right? So you're going to find out where you want to sit.
Okay. But do you think there are still, even with the amount of sophistication and institutions moving into the space now, do you think there are still these niche pockets that
absolutely.
smaller funds can find?
Look at prediction markets are a good way. I mean, every HFT shop I speak to tells me, we're in prediction markets, we're doing it. I didn't see that in the data. Okay, the liquidity is way too thin. I see a ton of alpha, and we're just getting into that at the moment.
Yeah.
Right? And I don't see these big players coming in and messing up the market. I don't see that at all. And then at the same time, we've got Hyperliquid is another example. I see people doing very well over there. Small shops are doing well with various strategies that they're involved in. Hyperliquid is something we're going to be looking at right now. So we're going to get into that in the next couple of weeks. So hoping to at least have something as a pilot in it. So I'm working on that. So there's a lot of interesting things going on all the time. You just got to know where to look, right? And these are the more well-known established exchanges. There are even second-tier and third-tier exchanges where you can find a niche and do something unique.
Yeah.
Right? So there's plenty of opportunity to do things. You just know where to look.
Is that the whole decentralized model? Because there's so many people building and different kind of products that there's a lot of these kind of opportunities? Or
I don't necessarily think that's true. I tend to think, yes, there are a lot of people doing things. I think a lot of those projects are pretty worthless, right? People are doing some interesting things. I mean, there's a lot going on in the space. It's just
how do you determine if it's worthless? Like, or maybe a better question, like when does something have value in terms of...
When it has utility, when there's some utility, when there's something genuine behind it. Like, for example, I mean, there are a lot of projects that talk about the features of what they have. They're faster, they're this, they're that, they're shinier, I mean, who gives a shit? I mean, it doesn't matter. Okay, at the end of the day, how do you solve my problem? I have this problem, this solved problem. If you can answer that, for me, you have genuine utility, and that's something that's useful. And there's too many of these projects which are not useful.
Yeah. So they're solving a faster, or they're like better at solving a problem that doesn't exist.
I mean, up until more recently, the VC market, the way it worked in crypto, encouraged dog shit projects to get funded, right? Because what they would do is they would say, okay, I'm a VC. I'm going to go to you. You've got your project. That sounds interesting. Okay. I'm going to do that. I'm going to do a token deal, and I'm going to dump my tokens on the market. And I dump to retail. I collect a ton of money, and I rinse and repeat, because every time I do it, I make money. Now, I didn't care about the project. All I care about is making money on the tokens of the project. So that went on for a long time. That's kind of died out now, which is great. But this is part of the maturity phase. It's maturing. It should be quality projects that get funding, not any project.
Because there was also retail just like blindly buying into it, right?
Well, then we had people on YouTube. We could name a couple of people who did this. I'm not going to, but you could name a couple of people. We talked about it before. But, shilling a whole bunch of garbage, right? And it's self-interest. It's wrong. It's unethical, right? And I don't like that. It makes the whole space look clownish.
A bit into like the derivative space again. Crypto derivatives themselves have grown up quite fast
Yeah.
So perps, derivative options, increasingly liquid vol surfaces. How mature is crypto volatility trading compared with listed equity or FX vol? And where do you still see the cleanest mispricings?
Look, I mean, that's a big question, right?
Yeah.
I mean, I have not been monitoring FX vol surfaces for a long time. Neither do I have any visibility into them. Look, crypto options, and specifically championed by Deribit, which was born and bred here in Amsterdam, we should say. They have, I mean, it was they did a great thing, right? They built a great business. Where the trading is now is quite sophisticated. So that was really, and I saw the sophistication picking up probably around about a year and a half ago. So people would write calls, and then they would, do some pretty simple strategies to actually pick up a good return. And you can't do that anymore. I mean, the market's priced those guys out. Yeah. So it's much harder now to make money in derivatives, crypto derivatives, than it was in the past. In the past, it was quite easy. Right? Now it's much more challenging.
And that's also something where, because you're from also more of the traditional background, how do you sort of look at the digital asset space besides, like you said, it's a bit more of like sometimes a bit clownish and such, but is that meaning where is the risk management, for example, like lacking behind? Because you already mentioned there's a lot of like kind of risks that they don't take into account. What are some of the sort of pillars that people should look at when they're maybe starting their own fund in this space, or also maybe the more traditional way? What are like core risk metrics? How do you even like define risk in your sort of?
Most of the people that have come into trading in crypto previously had started it almost by accident. You know, they stumbled into this industry, and then they've grown. So I met a guy who started Block Traders. I remember he told me the story that he had 200 euros, and he was sitting on his kitchen bench, and he was just doing a triangle trade between BTC, USDT, Euro. I think he was doing like this triangle, and he was just making money. He goes, "Oh, nobody's doing this." And people like me at that time, this was back in say 2016, 2017. When I looked at BTC for the first time, I looked at it and I saw these massive price gaps between different exchanges. Right? And so for me, I'm used to seeing basis points difference between things. So my immediate reaction is, this is bullshit, or it's a scam, or it's both. But whatever it wasn't for me. Right?
Yeah, because you were like, how can they sell the same product?
Exactly. It couldn't. How could it possibly be that you have such a difference, right? It couldn't. But other people who were not sophisticated said, look, I'm going to give this a go. I'm going to have a go. Let me see if I can extract that difference, right? Yeah. And I know some people that, I know this guy back in Australia who started a brokerage company over there. He did physical trades. He basically carried cash between countries to do these arbs between. He was going to Estonia or some other places, right? with briefcases of cash, you know, and he was doing physical trades to actually to get these differences. And he made a ton of money doing that.
In Bitcoin.
Back in the day, yeah. So people were doing these kinds of things. So
that's crazy.
Yeah, back in I don't know exactly.
It's a lot of hustling.
It was hustle, but but I would never have done that, right? I would look at this and say, this is a joke. So the people who didn't think it was a joke, right, and weren't sophisticated were the ones that actually got in and gave it a go, and they made a lot of money in the early days. Now, some of them got quite sophisticated, like Sander from Block Traders, or they've done very well. They're a very sophisticated bunch now, but others did not, right? The other way, right? So it's a mix. But I think the people coming into this space, they have initially they were very unsophisticated. They were not educated in the way of trading. They hadn't gone through the normal intern route that everybody else takes, and they just found themselves in the space, right? And then you have more sophisticated market participants. People have had that kind of background who are doing quite well now.
Any other, because you also said you like telling stories, any other stories regarding like the sort of early times, or maybe also like during the financial crisis, like 2008, anything there where you say like, that's a story I always tell?
I mean, 2008 was a unique time. I was working at Lehman Brothers, and it went bankrupt. That was unique. That was a unique time. I mean, that was an interesting time. I mean, it's very rare that you're in such an old, prestigious institution that goes bankrupt. So it was an interesting time. I mean, but yeah, no, I learned a lot in that time. I learned risk. I learned a lot about leadership. People that were MDs that you would look up to. You'd expect them to show the way, but when we went bankrupt, some of these guys just disappeared. You never saw them again. Whereas other people who were maybe not as senior stepped up and say, hey, I'll take care of this, right? So that was interesting to see. It was also, we had this concept at Lehman Brothers, this one world culture where we all work together as a big global firm. It's a lovely idea, but when we went bankrupt, it was every entity was fighting for itself. So we had to change the signatories on our accounts in Singapore. I know there were concerns that New York was going to try and pull money out. So we had to close that down because we had money in our accounts, right? And all these kinds of things happen.
So it all becomes like it's almost like biology, right?
Yeah.
Like once it goes wrong, everyone for themselves, and
it's like wrestling in the mud. Everyone's just going for it. And everyone's just trying to survive. And that was interesting.
So how do you define risk then? Is it like how much like your positions change on the day, or is it like the odds of?
You can have any risk metric, right?
Yeah.
And risk comes in all different shapes and sizes, right? But I think we know what risk is, right? But then you have operational risks. You have all these other kinds of risks. Some are market driven. Some you can see. Some you can't see. Some you have to estimate. Some you can get rid of, some you can't get rid of. Some you have to be mindful of. But the main thing is that you always think about them. At least you have some idea of how to deal with them. The worst way to deal with any kind of risk is on the fly. Right? You don't want to make up policy when you're in the middle of a crisis.
Having to change email signatures or anything like that.
You don't want to you want to change things. You want to have a process that you follow. So this bad thing happens, and the trigger is, this is a trigger, and then I do this, 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 and this. Right? And then
you have like for all the scenarios, you have like
you have a plan in place that if something happens, then you do this, right? And that is how you manage it. The worst thing is, something happens. Oh my God, we didn't think about that. What should we do? What should we do? That is the worst time. In a crisis, you don't be thinking what you should do. You should have the plan worked out.
Because it also goes very quick, right?
Like once yeah.
But now, speaking of going quickly, but being in a 24/7 market, you were also a risk manager before you founded Alphaparty.
I worked in risk management,
Yeah. So essentially, what genuinely keeps you up at night with the framework? With
what keeps you up now?
Yeah, no, with the
My children.
No, but I mean in the sense of
That's
running
also risk.
Yeah, exactly.
The risk of not sleeping.
But with running risk in in a 24/7 high volatility venue fragmented market with real counterparty risk, right? Like, what is something that you look for, especially now? Coming from already a risk management background.
What keeps me up at night? Well, nothing really keeps me up at night. I'm pretty comfortable with the way that we do things.
A very good risk plan.
Well, we have, everything we do is the trading we do is systematic and algorithmic. And we have risk metrics built into everything that we do. Okay. So if something was to happen, say we lost connectivity to the exchange, we get alerted, right? So we have an alert system. We have our own alert system where we're taking snapshots of our risk position periodically. We have real-time alerts when certain things happen. And we have basically 3 lines of defense. There's one person is the first line. If there's a notification, he'll be the first person. Like there's a severe notification, and he'll be the person to have a look. Then there's another person if he's not around, and the third person's me. So if I'm around, I'll be able to have a look too. But hopefully the other two check. I'm really the last line of defense.
So you're DEFCON 1.
I whatever you want to call it. I'm the guy at the back, right? And I'll get my hands dirty if everything goes.
Then you have to go to Estonia with cash.
I hope not. No, but we're in the fortunate position. I mean, we've got a fantastic team. We've been building great things. We've tested everything. Everything's well tested. We understand what we're doing. We look at our numbers all the time. And because we have great systems that we've built, we don't need to be worried what's going to go on.
Because maybe we can also talk a bit more about like Alphaparty in general, like because you talked a bit about your background. But what do you guys do? How would you describe Alphaparty, and why would it be unique for example, an investor to invest in Alphaparty rather than, for example, other funds? What makes you unique there?
Well, I'd say what makes us unique is the team. I think we have an amazing team of people. And I'm very proud to say that I've put this team together. And we TradFi guys. We all come from Merrill Lynch, JP, Lehman, Nomura, these kinds of backgrounds. And the team really understands risk, and many people, and we build it into everything that we do. And this is one of the reasons that we built Alphaparty Capital. Exactly this, right? Because we saw that this was a gap in the market, and if you, as a market becomes more professional and more institutionalized, then the allocators that are going to allocate money to that space, they want people to understand risk, and they talk their language, because risk becomes the most important thing for these guys. At the beginning, it's about returns, but then when the market becomes bigger, it's all about risk. So they need to know that you're going to take care of their money. That makes us unique. Well, not necessarily unique, but it makes us, I'd say, special. Our returns have been good. In the beginning, in the early days when we were running our own money and then some SMAs, we were doing over 100% gross per annum. Right now, those days are gone now. But last year we did 32.7%.
That's really good.
And now, it's been challenging this year in terms of the headwinds that we've had from many different avenues. But we're plowing along. We're developing, and we're sharpening our edge, and we're getting better. And we have an amazing structure that can take endless amount of capital. There's no cap on the number of investors or the amount of AUM we can have. The fund itself is a Cayman vehicle. We work with the best service providers in the space. So we have KPMG as our auditor. We have Signum, which is a Swiss bank that we use for custody and as a banking partner. We have Dentons that do our global legal. So we have great service providers. Our investment manager is FCA regulated in the UK. So we have a really nice setup.
At one point, that also becomes, like you're saying, when the space matures a bit more, it's not only about like how much return are you making, but it's mostly about like those kind of things, right? Like where's my money stored? Who's like managing the risk?
Because when you go forward, so if you want an institution to actually invest in you, you need to hit certain marks. You need to have a great structure like this, right, with these kind of names attached to it, and they're expensive, right? And then you need to have at least 100 million in AUM. You need to have a 3-year track record. So this is what we're building. We're building towards that. Now, when we get there, it's going to be a short list. In 3 years from now, there'll be a short list of people that have everything that an institution would need. We're going to be on that list. And it's not as if one of the guys on the list gets paid, everybody gets big chunks of money. This is a tiny asset class, right?
Absolutely.
So, and these are massive allocators, right?
And it's also like a tiny space in terms of actual proper funds, right? Like we're doing what you do with the names that you have.
Exactly.
And that's something that...
Yeah, I mean, what I'm seeing now is that the future of Alphaparty is that we will move to being multi-asset class, right? And multi-manager, right? So the future is really with other asset classes. So what's happened now is that we're past the point where traditional funds have decided to take their own crypto arm. They've built it in-house, so they've bought somebody that they needed to. So we're past that phase. So now we need to go and pick up equities, elements from fixed income, other alternative assets, and bring them into our own.
Right? But do you think, sorry to interrupt, but do you think your digital assets, so what Alphaparty started off with, do you think that will be your flagship service? Or do you think like you'll try to branch out and try to make it so that Alphaparty has parity in all of the services that they provide?
I would like to have parity in what we're doing, right? But I would like to be known for studying digital assets. Now, the margin in digital assets used to be massive. Now, that's come down a lot. So as that atrophies as well, it's another reason to go to other more traditional asset
but
classes.
then tokenized versions of those?
Tokenized versions I would still see as being part of digital assets. So say tokenized oil, things like that.
Why? Like in terms of, let's say, tokenized equities or tokenized bonds?
They're fundamentally different because of the wrapper, right? Because if you have tokenized oil, well, think about tokenized oil, for example. When we had the invasion of Iran and all the problems that we had over there, that happened on the weekend. You know, oil markets are closed, right? So people would express their trading opinion through tokenized oil.
Yeah.
So ultimately, it has different trading hours, right? It has probably different investor classes coming there. So it's going to be different.
Also different liquidity dynamics, right? Because then on the weekends, like it's really highly volatile.
It's still,
maybe
you know, the tokenized markets are still very thin.
Yeah.
But you can't really have a proper tokenized market unless you have points of liquidity.
Yeah.
Now we're seeing a few hubs, right? So Hyperliquid is come along as one exchange that's been really good, and we're starting to see, you know, other things going on.
So then to go a bit like even further back, you came through Applied Math and Astrophysics. You did doc in financial mathematics. How much of your real edge is the hard quant versus the market intuition built over 20 years of work? So for like a student today, which mathematics actually matters and what is romanticized?
Well, look, mathematics is really at its core conceptual.
Yeah.
It's about concepts. It's not, there's a lot of confusion about what maths is, right? People think maths is solving, you know, number equations. I mean, it's not arithmetic, right? It's not like, what's the square root of, you know, some large number. That's not maths, right?
Yeah.
That is, that's just a calculation. It's arithmetic. Maths is about concepts.
Yeah.
And they can be expressed in abstract ways through symbols, and then you're combining them and moving them and coming up with different things. So it's always very interesting to me, maths. I think for anybody who's studying now, I would say that the most important thing that they need to understand is actually AI, right?
Yeah.
AI can actually do very impressive maths work, right? And we're seeing some, recently we had, I think it was one of the OpenAI models solved an outstanding maths problem, which had been sitting there for about 70, 80 years. So by picking up, you know, different ideas from different types of maths, which hadn't crossed over before, right? Because people are kind of siloed in their own worlds, right? So going across the different verticals is enough to actually pick up. I think AI is really important. I wouldn't say that mathematical thinking is important. And if you're doing applied maths as opposed to, say, pure mathematics, applied mathematics is about solving actual problems, whereas pure mathematics is mainly about pushing symbols around a piece of paper. But it's still, there's a similar mindset to maths. I think applied mathematics is great because, you know, you're solving a real world problem. And of course, astrophysics was, I did theoretical astrophysics, right? And that was all, you know, solving partial differential equations, you know, general relativity, stellar formation, all of this kind of stuff. It was very interesting, you know.
Yeah. Do you still apply any maths when you're building any of these strategies, or is it rather very?
Yeah, we do. For me, I mean, I'm not involved in the nuts and bolts of models anymore. But, you know, other people on our team, like Arnaldo, for example, he spent he was at MIT, he used to work at NASA. He's a very experienced guy. He spent a ton of time, really, you know, he uses maths all the time, right?
And it's
but
like
he's using it with Claude, right? So he talks to Claude. He says, "Look, I think this." He gives.
And then Claude can like develop, like the sort of.
Well, he showed me some of the output that he got from Claude recently on some of the theoretical work he was doing, and you know, he'd worked on his own alpha for many years, and he actually uploaded it to Claude to get it to clean up the code, and it went through. There was part of the code which he couldn't remember. He didn't have any documentation for it. It was quite dense, and Claude decoded it and gave a perfect write-up of what was actually going in that piece of code. Then it suggested improvements to his alpha, right? And then suggested that his alpha which he had was part of a broader alpha, which he hadn't thought about, right? So it was coming up with genuinely new ideas.
But it just needs the right input, right?
Yeah, but then output everything as a LaTeX. LaTeX, you might know, is a typeset language for mathematics. It output a very large, thick LaTeX, perfectly reasoned piece, right, on his alpha. And he said, look, this is the work of a group of $1 million quants, right, at a place like Jane Street. And he was extremely impressed, and he's using it for every part of his work now. So but the insight here is that not anybody can do this, right? The toolbox, right? And you need somebody who understands what they're doing in order to ask the right questions and check things and prompt things in the right direction. And then you can get maximum use out of this.
Yeah.
Right?
So do you think that would sort of concentrate also the amount of like trading and capital that goes to very specific firms because they have the smartest people who can use these algos or AI, for example,
I tend to think that AI is going to be most impactful in terms of trading with teams like smaller teams can really do a hell of a lot more. Right. And incumbents like, say, someone like Optiva, for example, right? They might have endless compute and things and tons of money they can spend on things, and they hire the best people, all of this. But at a kind of fundamental level, I don't imagine they'll be able to change their systems to adapt quickly to things, right? Like small guys can pivot and they can use these tools to do things in interesting ways quickly, where I don't think you could do that in the bigger shop.
And I also wanted to touch like slightly upon, like, of course, alpha. Also, in general, we were talking about many things that you also mentioned in the Citi report with real world assets coming on chain. Then in the Citi report, they also talk about, for example, private credit markets and other markets like being tokenized. Where is sort of the alpha if it's so clear that like everything is moving on chain? How do you sort of define where to sort of allocate your capital in these markets
from an investor's perspective?
Yeah, from like an investor's perspective in terms of which verticals would be interesting for any investor.
It depends on your risk return profile and the time horizon over which you want to make an investment.
Yeah.
So everybody has their own risk appetite, which is different, and they have a different time over which they want an investment to mature, and that would lead them in different directions, right? There are some amazing tokenized funds which are out there now. The private credit funds, I think, are great. Having all these tokenized and giving people access to these is great because you might not have the minimum denomination if you're as maybe a large qualified investor. Maybe you can still access these markets, right, with a smaller denomination. So it kind of opens up these markets, which would tend to only be for very large investors to smaller investors. I think that's a great thing. I like the idea that you and we can both have an opinion on gold, for example, with Tether's gold coin. Right.
Yeah. So it really becomes something where like it's more like democratized, right? The way people could in theory.
I think it's good because for a long time there are many of these types of investment opportunities which are only with a very certain class of investment, right? And they can make a ton of money with these, right? And now other people can get access to this. I think more participation from smaller investors is a positive thing.
Yeah, and the whole report was also a bit more like cautious than you are, right? Like you're very, I mean, I assume because you're working in digital assets, you're very bullish and very optimistic about the space.
I'm optimistic about everything.
Yeah.
I think you need to be. You have to be an optimist.
Yeah, true.
Yeah, otherwise nothing ever happens, right? I'm an optimist. I'm delusional. I'm many things.
Yeah. No, but you have to be a bit delusional sometimes to make great things happen, right?
Yeah, but I mean, it's also kind of what he said in the beginning, where a lot of people are still quite uneducated. So when the institutions give out these reports, I think they fundamentally are more cautious because they haven't either done their research or they're still a bit iffy about it. But people who are already in this space and are making money off of it, or actually like actively researching the space and building it from within, are going to be a bit, or not delusional, but more confident in their words, right?
It also seems like a big space when you're in it, But then when you step out of it and you realize it's like you said, like 3 trillion compared to like equities, for example, like it's so small.
It is very small. It's a very small market. That's one thing that we need to understand.
Yeah, but also the number of parties operating in it were actually like the main drivers of the space, right? There's very few parties who actually can move the needle. And also very few parties who are actually, like you're saying, like 90% it's just trash in that sense.
Complete garbage. Yeah.
So
I mean, I see the winners. The winners are projects and tokens that have genuine utility.
Yeah.
Right. So if you think about, say, Tron, for example, right? You can say what you want about Justin Sun, right? But at the end of the day, more than 50% of all USD transactions are settling on Tron. Tron is getting income.
Yeah.
Right. So then there's a use case. There's genuinely, you think, okay, well, that can go somewhere.
Yeah.
At the same time, if you're looking at any chains that through transaction costs, they're getting more value. They're worthwhile. Then if you look at Hype, itself is getting a lot of value from the trading activity on the exchange. So these are assets of value. But then Fartcoin, what's that? What a lot of garbage, right? Who's going to buy that nonsense? So all that stuff's going to go to zero, and then you end up with a couple of good assets in the space.
Yeah.
And then all these tokenized assets are really interesting, right? So you'll have Bitcoin, you'll have a couple like probably Sol and a few others, but mostly they'll go to
and then you have like mainly the infrastructure that's being used for tokenizing assets, right? Yeah. Because that's how it seems to be going now, is where you have very few projects who are able to drive value through just like purchasing the token, and then it's like the technology behind it is being used by, for example, banks or any party to like tokenize, right?
Yeah, the two biggest themes at the moment in the space are tokenization of real world assets and stablecoin payments. These are the two big themes which I will expect to continue. And stablecoin payments are only going to get larger, right? Payments are a big problem, right? In the real world. So it's solving a real world problem that companies are having. So I had a call with Uber this morning, right? I was talking to them because it might be interesting to them to consider looking at payments in some aspect in stable coins, right? Because they might be able to save a bit of money. Given the volume that these guys do, billions and billions per day, even a small few basis points saving, or a basis point or a sliver of a basis translating to a lot of money. So, it's important for them to, and then there are some countries like in Turkey where, maybe you have some problems getting money in and out of the country. So payment rails through crypto becomes interesting. It's a big country.
I mean, also like a lot of internationals here, right? They sometimes struggle by simply sending a small payment to their parents or
like
their parents.
Remittance payments. Yeah, the remittance payments.
Any payments like cross-border payments, and then it takes like 3-4 days to settle. And you're like, I just quickly want some money for this or that. And like, it just doesn't come through. So it's like T+3 in terms of like settlement doesn't really work. I feel like in the speed that we're like operating today, right? I think that's also, how would you, from the perspective of, let's say you have like the infrastructure like Solana and you have the token, but as like a retail investor, you want like exposure. Let's say you don't want exposure to a tokenized asset, but you want exposure that you believe that everything is going to be tokenized, and you want exposure to the party building the rails, right? So the crypto
party.
That's
where a lot of money from VCs has gone more recently. It's into building the picks and shovels.
But as a retail investor, it's very tough to get in.
Well,
there,
I mean, look, guys like Securitize, they're the guys that do the tokenization. These kind of guys are the ones that you want to invest in. So how do you invest in those guys? I know. I mean, they haven't got a token. They're more like an equity play, right? But they would be the guys that you want to invest in.
Not financial advice, by the way. Good slide. Just
we can't do
before
that.
We're also doing a capital raise at the moment.
Okay.
So if people want to invest in us, it's possible.
Fantastic.
Yeah, and
what ticket size are you looking for?
Well, we're only raising like 1.2 million, right?
Oh, okay.
So it's a small at a valuation of 10.
Okay.
So it's minimum tickets are about 100K. But
okay.
Do you guys also do the traditional fee structure, or are you like Renaissance?
No, we charge 2 and 20.
Okay.
Yeah.
Not like 5 and 60 or 5 and 50.
It was 5 and 44.
Was this Winston?
No, it was Jim
Renaissance.
Simons. Yeah.
I think Winston is also doing.
Winston have some pretty high fees.
Yeah.
Yeah. I think they're transforming themselves into more of an OTC shop. But I told them, if you're going to charge such high fees, just go private.
Yeah. Yeah. And also, just one more thing before like we start coming to the like real alpha and like closing everything off. Yeah, I was just wondering, like, any advice for like entrepreneurs or people starting their own funds.
Entrepreneurs, I would say, it's a journey. It doesn't happen overnight. You need to be persistent. You can't give up. Don't give up. You have to keep on going. Things are always hard. Nothing goes according to plan. And it always makes me laugh when people talk about business plans.
Yeah.
What's your 5-year plan? What's your 10-year plan? What the hell are you talking about, right?
What,
I didn't even know what I'm going to be doing next month. Yeah. Right? I mean, you're constantly punched in the face and you've got to work out what to do next, right? But that's just the result of, entrepreneurship is something that you can't teach this stuff, right? I mean, you can learn from great entrepreneurs, right? And I think you have to always see yourself as a student rather than a master. I'm always trying to learn. I want to be better than who I was yesterday.
I think it's also, as an entrepreneur, you always need to be eager to stand at the forefront to learn about the new ideas, right? Because otherwise, if you're going to try to get in on an existing model or an existing market, you're not like as quickly going to add value as if you're like pioneering
it depends what you want to do. I mean, you can be an entrepreneur that's building rockets and sending them into space. Or you could be an entrepreneur that's just buying up dry cleaning businesses. Different types of entrepreneurs. Some can be very exciting, some might be extremely boring. But when I started my journey as an entrepreneur, I came from finance and then I did a whole bunch of other businesses. Yeah. And then I realized, hey, I've learned through all these businesses how to actually be an entrepreneur. Let's do something back in finance again. Because that's where you make a ton of money.
What was your first business that you started?
The first one was when I went back to Australia. I started this platform called Uda. And Uda was for chefs to order all of their supplies from all of their suppliers, right? It's a big problem. Yeah. So in the supply chain for restaurants. So I knew some chefs and I saw the problems that they had. And I thought, oh, look, I kind of have a solution here, right? So we, me and a business partner, we went and we looked at this. And we saw that this is a genuine problem. So the way in which people were typically putting in orders is at the end of service. So say 10 o'clock at night, they would pull up their suppliers or they'd text their suppliers saying, I need, 20 kilos of topside beef. I need 30 kilos of carrots or whatever it was, right? And they would just send the messages, but there was no receipt of confirmation. There was no, and then things would turn up the next day and sometimes things would be wrong. So we set up a system where they could order just from their phone. We built that into a platform and then we started to scale it up. So at its peak, I think we had about 300 restaurants, about 300 suppliers.
Wow.
And, actually, it was a real problem. And
300? That's
we had 300. It was all in Melbourne. And we just knocked on people's doors. We were like knocking on restaurants saying, hey, we've got this thing. And we gave it away for free to everybody, right? And we kind of didn't know, we thought like we're solving a genuine problem here. But we didn't ever have a revenue model, right? Because we thought, who's going to pay? Right? Because on one hand, restaurants have very tight margins. They're not going to pay anything. So if they're going to get it as a service, that's great. And then we had the suppliers didn't want to pay either, right? So then we thought, well, maybe we should do it such that we have a discovery system or we rank people like in Google, so big guys are different, and we never really worked it out. Like we kind of came to a point where my business partner ran out of cash, and we didn't go and hit up any VC funds. I kind of self-funded everything, did the whole thing myself. So a couple of $100,000 down the toilet. But it was a great learning experience.
Yeah, but you solved a nice problem.
Well, one thing I solved, the first problem I solved was that we didn't have a tech co-founder. Right? So you need to have your own in-house tech. So we tried to outsource the tech to a third party. Right now, of course, a third party just wants to milk you for fees. Now they were really good, the guys that did the build. They were not our guys. We needed our own tech in-house. Now looking back on it, it seems obvious, right? At the time you didn't know. So you learn these things. I built a marketing agency as well. So it was a digital marketing agency back in the days when you could have you could run revenue positive ads on Insta and Facebook, right? So I ran these ads for single product entrepreneurs in Australia, guys that had teeth whitening products. And stuff like. So it was basically, it was a bit like trade. It was kind of like you were trading people's attention. So you're kind of doing that. So you're kind of like buying and selling. You were looking at, the cost per click and, so I did all that stuff. It was kind of mathematical and fun and performance marketing, I guess you would call it. And so I did that, built that agency, exited that. And then I decided to start my own brand because I could see how stupid a lot of the people that we had helped build their businesses were. I thought, well, I can build my own business, right? So I built a business based on an insight from my wife, which was back in Australia at that time, women had these neoprene handbags.
Okay.
Yeah, they were made out of like a wetsuit material, right? They're very light. They wanted these easy carries they could take from the beach. They could take them with all their kids' toys and all this junk. And these kind of bags were trending, right? So I said, well, I can build a brand around that. So I found someone in China that could manufacture these bags. Yeah. And I paid for the first order, 10,000. And then I sold them. 10,000. I created my own ads. I got one of my best friends to be a model. Down the beach, took photos of it with the bag. And then I just churned it. And we were so cool, for every dollar I put in I think I spent like 25% of the product value I spent on marketing to get a customer. Okay. And so we made a ton of money.
That's so good.
That's really nice.
That was right. Yeah. First year was fantastic. They got sued and that had a problem with the product, right? Because in China, they in the factories, they screw you, right? They change the buttons. We had some crap button that broke. Then you pay someone to check the shipment and they get paid off by the factory. It was a disaster, right? So I had this bad stock that went out, had these tons of refunds, and at the same time I got sued. So I said, forget it. So I just closed that one, right? But they're all interesting. I still made a lot of money in that one.
Yeah.
That was good.
Okay, that's good.
But then nothing pays as well as finance, right? If I told you how much I used to earn, I won't. It was a lot, right? So then, now I got 4 kids. When I came back to Amsterdam, we came back during COVID. I thought, well, look, now is the time, and life was very insistent on making a big bag of money again. Yeah. So I went back to finance, and here I am with my own hedge fund. So
and this is like a bit of a mix, right? Because now you're entrepreneur, but you're also back in finance. So
exactly, it's what I know. With what I've learned, being an entrepreneur in finance is a great place to be, and you can do some damage.
That's what we're doing, right? With the podcast, we're doing some damage.
Yeah, sure.
You always want to do some damage.
You haven't earned a single cent off of this one.
You will. I'm sure you will.
One day. Yeah, if we get more stories like yours, we'll make back on the advertisements.
Absolutely.
Any last remarks? Because you always do a rapid fire, right?
Yeah, we do some rapid fire questions. Mm-hmm. One traditional financial derivative concept every crypto trader should master.
No, if there is one.
Changes
buy low, sell high.
Any one risk metric everyone should look at?
I would say in digital assets, I think counterparty credit exposure is the most underappreciated risk.
Yeah, and in traditional finance?
And TradFi, I wouldn't know. I'm not sure. I don't have an answer. It depends. I mean, TradFi is big, right? Equities,
humongous.
Commodities, they're all different risks. Physical commodities as opposed to pay commodities. I mean, they're all different, right?
Yeah, that makes sense.
There's not one thing.
All right. In 5 years, does the series derivatives volume sit on centralized venues or on chain?
Centralized.
Yeah.
I think in the future, if you'd asked me a couple of years ago where I saw the future of trading, I would have told you that price discovery is going to be via centralized order books. Yeah. But settlement will be peer-to-peer, right? Which is basically Hyperliquid, right? Yeah. And because this way you don't have to worry about the exposure of the venue, and you can just peer-to-peer it, right? So I would say centralized order book is going to be the way for price discovery of the future. Yeah. When things are settled, I think it's going to be more peer-to-peer.
Okay.
Yeah. How that works with derivatives is going to be interesting to see how that works from a regulatory perspective. And I think that's probably the biggest challenge to this.
So it actually, in that sense, like decentralized finance kind of changed until it found sort of its way, right? Like the technology was so valuable.
It's still finding its way. It's still finding its way.
But a lot of,
I mean, one of the biggest problems with DeFi is really knowing your counterparty. What's the KYC? There's no or very little, due diligence done over here. And that's a problem. If I'm a large venerated organization, I have to know that I'm not trading against an arms dealer from Iran, right?
Yeah.
I gotta know that. I'm going to be in trouble.
Yeah,
that's true.
So if I'm a proper institution, I don't want to be in that space.
Yeah.
I'd rather not be there, because it actually jeopardizes my business as a whole.
Yeah.
For this small little potential piece of profit.
Yeah.
Makes
So
no
then you have
sense.
to do everything yourself, like all the. Yeah.
Well, as things become more mature, and as governments and regulators become more educated, then we're going to see better policy come out. I know a lot of people, whenever they hear regulation, they say, "Oh my God, that's terrible." But it's the sign of maturity, right? You need regulation, as if you can do something outside of the sphere without regulation. I mean, I remember back in the early days of crypto, all these guys were, fuck the banks, we'll do it our own way. We're going to do it our own way. I mean, you're going to work with the banks, right? They are part of the financial system. If you want to be part of that, you work with them.
Yeah.
Right?
Yeah. And how are you going to go from 2 trillion to 100, 200 trillion if you're not willing to work?
Exactly. You're going to work with these guys.
Yeah.
Right? These guys know what they're doing. They know something. Okay. And they're not evil.
Yeah.
Banks aren't evil. They do whatever they can within our capitalist society. Right.
Yeah.
And they follow the law sometimes, most of the time. Some of them don't, like some private banks, but that's another story. But they do what they can within the sphere, right?
Yeah.
They're a business. They're trying to make money for themselves.
Yeah. Thank you so much for your time today.
Yeah, thank you.
It was very interesting. Yeah, because we covered like TradFi, DeFi,
we covered
a little bit of entrepreneurship.
We could have talked a little longer, I think.
Yeah.
I have a few things to say.
Yeah. I feel like you always have like a good story to tell, right?
Yeah,
It's
I like
I mean, we can also do a part 2.
Yeah, well, I'd
yeah.
love to. I'd love to have you guys again.
Yeah,
You've been delightful hosts. I wish your podcast every success.
Yeah,
Thank you.
Yeah, we're really
We can do a part 2 very soon then.
Yeah, let's do it.
Yeah.
And then
Happy to.
also in this nice space with the nice weather, the nice like summery outfits.
Nice air
for you.
conditioner. You're looking good. Get the black thing going.
Yeah. The black, the white, and the summer.
Yeah. It's so hot today.
But yeah, thank you so much, guys, for tuning in today. We look forward to sharing more insights over the upcoming episodes also. And feel free to check out our channel, and don't forget to, of course, subscribe so that we get some kind of retention mechanism in there. But yeah, thank you guys so much, and then we'll see you next time.
Thanks,
Thank
guys.
you.
Yeah, and then let your friends and family know that Rob is doing a cap raise right now. So
Oh yeah.
yeah, so
Thanks.
Let's get into that
we should fill
1.2.
that pretty quickly, I think.
Yeah.
I think we have most of it.
Maybe the next one then.
Huh?
The next one,
Yeah.
the bigger
I think
raise.
there will be a bigger one. We need it,
Yeah,
It's
yeah.
a small one,
Fair
yeah.
enough. You guys are not greedy.
Well, we don't need to be. I mean, we are greedy, right? But we don't want to raise too much money that we don't need.
In the end, it's still finance, right? So in the end, it's still finance.
Yeah, still
so.
finance.
Of course, it's just money.
Right.
Hedge fund
Awesome.
life.
Perfect.
Thanks, guys.
That was really nice.
Yeah.
I think that time-wise, we were also good, right? Like,
How long is the podcast?
We generally try to keep it for like an hour.
Let's do a self.